Welcome to The Explainer. I'm so thrilled you're joining us today. Look, if you're a focused learner trying to understand exactly how the global financial plumbing is being completely rewired from the inside out, you are in the exact right place. Today, we're unpacking a massive paradigm shift happening right now in 2026. We are talking about how stablecoins have definitively broken out of the cryptocurrency sandbox and transformed into an institutional-grade utility. They've evolved into what financial experts are now calling a systemic mezzanine layer of corporate finance. Basically, it's this dynamic layer of money sitting right between sovereign central bank reserves and your traditional commercial bank deposits. Okay, let's dive into our roadmap. We're going to cover the mezzanine layer, the APAC adoption gap, Asia's regulatory revolution, freeing trapped corporate cash, and finally, the modern CFO playbook. All right, up first, Section 1. The new mezzanine layer, separating the myth from the reality. So just to wrap our heads around the sheer scale of what we're dealing with, $321 billion. That is the global stablecoin market capitalization right now. We are absolutely not talking about some fringe experiment anymore. We're talking about massive, verifiable, institutional scale with annualized network transfers that legitimately rival legacy networks like Visa. Now, out of an estimated $62 trillion in annualized gross transfers, a huge chunk of that is just high-frequency algorithmic trading and DeFi routing, but about 7%, which is still a whopping $4.2 trillion, represents genuine, verifiable, real-world economic activity. And here's the absolute kicker. Within that real economy, business-to-business transactions now make up about 40% of the volume. And that specific B2B segment? It's growing at an insane 65% compound annual rate. Corporations are demanding instant cross-border routing, and this is exactly how they're getting it.
Which brings us to Section 2, the APAC adoption gap. Basically, why the regional hesitation?
The contrast across the globe is, it's pretty staggering. In the United States, enterprise openness to stablecoins is sitting at a massive 72%. That confidence was hugely catalyzed by the U.S. Genius Act in 2025, which gave everyone regulatory certainty by mandating 100% reserve backing in high-quality liquid assets. But over in the Asia-Pacific region, openness is hovering at just 20%. So why are they holding back? Well, the first big roadblock is what experts call the API gap. Listen, Asian corporate treasurers have zero, and I mean literally zero tolerance for clunky standalone crypto wallets. They are absolutely not going to overhaul their entire accounting ledgers for a new tech toy. For them to adopt this, the technology must be completely invisible. It has to be a back-end routing mechanism flawlessly integrated via APIs right into their existing enterprise resource planning and treasury management systems. If it's not seamless, they just aren't interested. The second hurdle is this macroeconomic fear of digital dollarization. Historically, over 93% of stablecoins have been pegged to the US dollar. But think about it. If an APAC corporation relies entirely on USD assets, it creates massive foreign exchange accounting friction. It leads to dangerous balance sheet mismatches between their dollar-denominated assets and local currency liabilities. Because of that, there's this massive pent-up demand for stablecoins pegged to local currencies like the yen, the Singapore dollar, or the Aussie dollar. Moving on to Section 3, Asia's regulatory revolution. Let's do a quick 2026 jurisdictional deep dive. To give compliance committees the absolute legal certainty they crave, domestic environments across Asia have become incredibly strict and tailored. We're seeing Hong Kong mandate one-to-one high-quality liquid assets, Singapore requiring one-to-one backing in the exact same currency, Japan enforcing 100% trust or cash backing, and Australia running everything under really strict financial services licensing. Let's zoom in on Hong Kong and Singapore for a second. Hong Kong is playing hardball. Mandatory local incorporation and a steep $25 million capital requirement. But hey, it's working. Tier 1 banks like HSBC and Anchor Point have officially secured licenses. Meanwhile, Singapore is issuing an exclusive MAS-regulated label of trust. But the real game changer over there is the Paxos Global Dollar, or USDG. Legacy stablecoins use a model where the issuer just pockets all the interest earned on the reserves. Paxos completely disrupts this by structurally sharing that yield back with its institutional partners. It literally transforms stablecoins from a cost center into a revenue-generating network. Over in Japan and Australia, the the landscape is just as fascinating. Japan has this super strict dual-track system that legally isolates token issuance from distribution, creating a heavily protected bank-grade ecosystem driven by the Progmat Coin Consortium. But here's the macroeconomic catch. Japan's 10-year government bond yield hovers around a tiny 2%. That means Japanese issuers can't just live off float income. They're forced to aggressively drive huge B2B transaction volume and live off settlement fees. And down in Australia, their fully collateralized AUD stablecoin just blew past an impressive $1 billion in organic volume. That proves the hunger for non-USD assets is very, very real.
All right, Section 4, freeing trapped corporate cash. This is where we see the end of correspondent banking friction.
When you compare the two systems side by side, it's honestly like night and day. The legacy correspondent banking network is an absolute labyrinth. You've got T+2 days settlement times, arbitrary cutoff windows, opaque fees. It forces multinational treasury teams to hoard massive amounts of pre-funded cash in regional accounts just to make sure local subsidiaries can make payroll. It traps trillions of dollars in idle liquidity. Contrast that with stablecoin rails. They are always on, 24/7, 365, settling globally in minutes. CFOs can execute real-time automated cash sweeps across the globe, totally eradicating the need for those idle trapped balances.
And it gets even better when you look at programmatic supply chain finance. Historically, if a big corporate buyer demands extended payable terms, like net 90 days, it absolutely crushes their thinly capitalized local suppliers. But by combining stablecoins with smart contracts, you solve this instantly. An IoT sensor registers a digital proof of shipment, and boom, an on-chain escrow instantly releases a low-cost stablecoin payment to the supplier. It completely democratizes working capital without relying on fragile localized bank factoring.
So, what do we do with all this? Let's get into Section 5, the modern CFO playbook, your actionable directives for 2026. According to the research, if financial professionals want to safely master this new digital liquidity paradigm, there are 4 exact steps you need to take right now. Step 1. Segment your liquidity strategically. Treasurers need to enforce a strict policy here. Secure your operational coverage first and optimize returns second. Treat stablecoins strictly as tools for speed. Use them for your same-day needs. Because traditional issuers generally keep the yield, you should almost never use a stablecoin as a long-term primary investment. Once those daily operational bills are paid, sweep that surplus cash off-chain into traditional money market funds or repo markets to actually get your yield. Step 2. Establish digital treasury pots. Look, because traditional banks are being bypassed here, all that compliance, tech, and operational risk lands directly on the corporate balance sheet. CFOs, you cannot operate in a silo anymore. You've got to build cross-functional teams, pulling in finance, IT, legal, and procurement to constantly audit where these issuers are holding their fiat reserves, map out those tricky global regulations, and manage novel smart contract vulnerabilities. Step 3 is all about prioritizing API interoperability. Seriously, do not invest corporate capital into manual web wallets. You have to mandate that these blockchain rails feed continuously standardized real-time data straight into your existing unified liquidity dashboard. Getting that centralized data governance totally flawless is the absolute prerequisite before you can even think about deploying advanced AI-driven forecasting models. Which leads perfectly into Step 4, preparing for the foundation of AI-driven commerce. Deploying regional fiat pegs on native digital rails is exactly what allows AI to function in commerce. Traditional fiat banking systems, with their batch processing and rigid delays, are fundamentally incompatible with autonomous machine-to-machine transactions. Stablecoins running on immutable ledgers provide the vital, frictionless plumbing for the impending agentic economy.
Which leaves us with a really critical thought to chew on today. Is your corporate treasury prepared to serve as the foundational liquidity layer for an AI-automated global economy? Or are you going to stay trapped in the friction, the delays, and the trap liquidity of the past? The technology is here, the regulators have set the rules, and this mezzanine layer of money is officially open for business. Thanks so much for joining me on this deep dive. Keep learning, keep analyzing, and we'll catch you on the next explainer.